Good morning, I'm Fred Philpott. Welcome to Gough Square Live, and the subject of this episode is consumer credit legislation, looking at where we were, where we are and where we might be going. It's been 11 years since the last shake-up of consumer credit legislation. That was, of course, due to the changes in 2014 and before that and after that, but centralised in April 2014 on the transfer from the OFT finally to the Financial Conduct Authority, which had recently been the Financial Services Authority. That was preceded with a shake-up in, let's say, 2010 as a result of the Consumer Credit Directive 2008/48, about which, much of which I'm going to say today turns. One of the major interests, if I may put it that way, is reset. I'll come to reset in due course. It's often said that we don't know where we are, and we certainly don't know where we're going unless we know where we've been. And many in the industry, both lawyers and non-lawyers, do not fully appreciate the history of consumer credit legislation. I will not dwell on it, but we've had consumer credit legislation since the usury laws, which were not repealed until 1854. They went through numerous changes as regards rates of interest and so forth. Following the repeal in the same year was the first Bills of Sale Act, 1854, which was for the protection of creditors, not the protection of consumers. It was so that someone considering lending money to a consumer would see a lovely piano in their living room and think they owned it, and therefore they were security for the loan, not knowing that in fact it was subject to a security bill of sale. That was afterwards extended in 1882 to the Bills of Sale Act, which was for the protection of creditors, laying down similar formats as we see now in our agreements regulations. The Moneylenders Act came along in 1900, and it's worthwhile having a look now at the overall picture, the overall timescale of how we've evolved since the Moneylenders Act 1900. It was succeeded by the Moneylenders Act 1927, the 1900 Act being primarily involved with registration and with the first hint of unfair relationships, then called Protection Against Unconscionable Credit Bargains. And therefore there were those years, 17 years before the 1927 Act, bringing in what would now be very much similar to the agreements regulations, although in much truncated or different form. The Act was much more simple, although one would not think so, looking at the case of Askiness and Green, 1969, 1 Queen's Bench 277, where Lord Denning, Master of the Rolls, formerly a graduate in mathematics, had to explain in great detail how the interest formula was worked out. Otherwise, it was fairly straightforward. Alongside the development of the Moneylenders Act, we had the Hire Purchase Acts, the first one being the Scottish Act of 1932, and then the Act extending to England in 1938. Then, of course, came along the Consumer Credit Act. There was also, one must not forget, the Pawnbrokers Act of 1800. So these parallel consumer credit pieces of legislation were going on at the same time. But the overview is from 1900 to 1927, 17 years, 1927 to 1974, 47 years, and since 1974, of course, 50 plus years. Is this a bad thing? That is that nothing is going on very much. There has, for example, been an issue regarding the regulatory reforms on consumer credit, regarding credit broking, debt adjusting, debt counselling, etc., requiring a policy statement, PS 25(2). But those sort of minor matters are nothing compared with the overall reform of consumer credit, which we experienced obviously in 1974, leading to the batch of 13 regulations and orders of 1983, which in the main, particularly the agreements regulations, the cancellation notices regulations, the default and termination, etc. regulations came into force on the 19th of May 1985. So 85, 95, 05, here we are. What is going to change? Well, the 2014 legislation required under the Act to have a review, that's the Financial Services and Markets Act Amendment of Regulated Activities Order 2014-366, with regard to the review on a 5-yearly basis. This was carried through, and the Department of Business, of course, that was previously known as BEES, the Department for Business and Trade, reported in 2019 that they had reviewed matters under the auspices of the FCA's report, and one of the major messages there, paragraph 120, was that with regard to the repeal of the Consumer Credit Act, this could adversely affect the degree of protection for consumers. And therefore, the idea of the repeal of the 1974 Act and its incorporation into the handbook, CONC in particular, was not recommended by government. But nothing happened, and nothing has happened of any significance. It was an opportunity to review consumer credit as a whole, but on the sidelines, and here we come much more up to date, on the sidelines, the original directive of 1987/102/EEC, which had little effect on UK law because it's primarily based on UK law. The new directive, as it was called then, of 2008/48, brought enormous changes, and in particular our historic attitude to consumer protection under legislation related to the contract, the agreement. Everything turned on that almost. There were provisions in, for example, the 2004 regulations for advanced information, what became the SECI, but by and large, the UK law on consumer credit legislation relied on the contract. Not so the EU directive, which relied on front-loading to a much greater extent. And so therefore we had, under the 2008 directive, implemented by the 2010 regulations in the UK, a system of both the adequate explanation followed by a SECI, the Standard European Consumer Credit Information Sheet, and then the contract. Well, a lot of people didn't go much on that, and certainly not the doubling up of adequate explanation and the Consumer Credit Information Sheet. The 2008 directive has been subject of the new directive of 2023/1225, directive of the European Parliament and Council of the 18th of October 2023. This poses a dilemma for the UK. I'd previously considered, when this was first broached in 2021, that the UK could do a number of things. It could implement the directive, or adopt might be a better word now, or it could cherry pick any good parts there were and incorporate into whatever future legislation comes out of the 5-year reviews, or it could just politely acknowledge it and ignore it. One of the reasons that was thought to be likely is that a wholesale adoption, implementation, if one wishes, of an EU directive would be considered politically objectionable. People voted in 2016, by a margin, not to have their laws dictated to by the European Union, and therefore to simply acknowledge and adopt an EU directive would have been thought to be unlikely. The other piece of legislation, going back to where we were in domestic terms, was of course the 2006 Act. This has nothing to do with the EU, but was brought about to bring in specific, for in particular, pieces of law to deal with particular problems. It introduced the unfair relationship regime, which most people agreed was needed because the extortionate credit bargain regime under Section 137 of the 1974 Act was thought to be out of date and concentrated too much purely on the terms of the agreement rather than what happened or did not happen afterwards. The other piece of important legislation was the abolition of Section 1233 and 1234 of irredeemable unenforceability. Again, everyone by and large agreed that was a good thing because of the problems it incurred, such as Wilson and First County. In addition, there was the implementation of suggestions that there be post-contract information by way of statements and notices under sections 77A now and 86B. The least said about those, the better. They got very little attention, but those involved in those sections and ancillary ones will know how much trouble, that's an understatement, they have caused, because it was not investigated to any extent or debated in Parliament. Going back to the new directive, that is going to come into force in 2026. The requirement is to have laws, etc., regulations made by member states in November 2025 with full implementation on the 20th of November 2026. As a useful correlation Annex 4, setting out how the new directive differs from 2008. There are two particular highlights. One is the integration of crowdfunding rules and also the control or, in some ways, restrictions on digital communications. It is thought that perhaps the legislation in the directive on digitalisation could be a choice item for UK legislation and reform. But the wholesale adoption would mean following EU rules, rewriting to some extent the 2010 regulations, changing the monetary limits being another part of the 2006 Act, which merited a lot of debate, unlike 77 and 86B. And therefore, the future is uncertain, but in particular, we come back to reset. Reset is an expression coined by the government to reset the relationship between the UK and the EU. It's been in the news recently, but it was the aim of the new government to have this reset, which some saw as going simply back into the single market without actually saying so. Undoubtedly, the object of reset will, to some extent, involve a return to single market rules, and it is said that this is important because it will cut down bureaucracy, not least of all in trade as regards Northern Ireland. But recently it's come to the fore because with all the discussion about immigration, it has been found out, it is said, that the EU Commission are depriving the UK of intelligence, not only on individual migrants, such as fingerprinting, but also on people smuggling, because they want to use it as a bargaining chip to get us into Europe more by way of reset. Now, what could be an easier, cheaper, non-political giveaway than saying to the EU, oh, also, we'll continue to harmonise our consumer credit legislation with yours. That's a good bit of resetting our relationships. So that is a possibility. What might happen? Well, consumer credit has not been political to any extent. In particular, it will be recalled that the 1974 Act came about because a similar bill had been introduced under the Conservative Edward Heath government, which fell, and therefore the bill fell, but it was reintroduced in substantial form with all-party agreement effectively. There was a bit of political debate about the consumer credit advertisement regulations when they introduced the concept of your home is at risk if you do not keep up, etc. This involved First National Bank taking the matter by judicial review to challenge the validity of the statutory instrument. It ended up in R.V. Secretary of State, ex-party First National Bank, 1990 Trading Law Reports at 184. It failed, but it shows that there is a scope because unlike Acts of Parliament, a statutory instrument can be challenged. As we all know, under the Statutory Instruments Act 1946, there is the affirmative provision and the negative provision. The negative procedure requires that the instrument be laid on the tables of the houses, and unless challenged, it becomes law. But one can see the possibility of a challenge if, by way of amendments to the 2010 regulations, the new directive 2023-2225 is adopted effectively whole-scale. One can see a motion of opposition saying that this is, in effect, going back to the free market and overriding Brexit. The answer is, to the future, there are really three things to do. One is nothing, which is popular because disturbance, upheaval, when one's got used to the 2010 regime. Or secondly, to make internal changes, as they may be adopting the digitalisation provisions of the new directive, but also changing the mess that we are in respect of the 1983 regulations governing some consumer credit, others governed by the 2010 regulations, bring in MCOB, bring in buy-to-let, and one has this, which can only be described as a mess. We've got used to it, but another upheaval, simply tinkering with that mess, is unattractive. One needs a combined effort as a result of the 2019, soon to be another review, and to do something about it. The third alternative is to adopt the new directive wholesale with the consequences I've already spoken about. Thank you very much. Thank you for joining us at Gough Square Live. The next episode is to be on the 3rd of June, and we look forward to seeing you then.